Imagine the U.S. housing market on the brink of another crisis, as if the lessons of the past were poised to repeat themselves. With the dawn of 2024, a series of economic pressures is converging, creating a perfect storm that could shake the very foundations of the housing sector. Rising interest rates, once a tool of monetary policy to combat inflation, are now raising the cost of borrowing, making homeownership increasingly elusive for many Americans. As mortgage rates climb, prospective buyers are feeling the squeeze, and existing homeowners are finding refinancing options more daunting. But the challenge extends beyond just rising rates. The affordability crisis, exacerbated by soaring home prices and stagnant wages, has already made it difficult for many to enter the market. With inventory shortages persisting, the competition remains fierce, driving prices even higher. Meanwhile, economic uncertainty and potential job losses cast a shadow over the market, potentially leading to higher foreclosure rates and reduced buyer confidence. In addition, overvalued housing markets are teetering on the edge, vulnerable to corrections if economic conditions shift abruptly. Coupled with changing mortgage regulations and evolving demographic preferences, the housing landscape is anything but stable. Understanding these intertwined factors is crucial as we navigate a potentially tumultuous year for the housing market. As these pressures mount, staying informed and prepared will be essential for anyone engaged in the real estate world. 1. Increased interest rates. The housing market's impact is becoming more apparent as the Federal Reserve continues to raise interest rates in an effort to combat inflation. The affordability of housing can be substantially impacted by the rise in mortgage rates, which is a direct result of higher interest rates. Potential homebuyers may be discouraged by the increased cost of mortgage payments when borrowing costs increase. For instance, a 1% increase in mortgage rates can result in monthly payments that are hundreds of dollars higher, thereby rendering homeownership less feasible for a significant number of individuals. The demand for housing may also be impacted by this change in borrowing costs. A housing market slowdown may result from prospective buyers delaying the purchase of a property or selecting less expensive properties. In the past, the decline in housing markets has been linked to the increase in interest rates, and the current trend has the potential to similarly suppress home sales and price appreciation. Existing homeowners may also encounter challenges refinancing their mortgages as affordability decreases, which could result in an increase in default rates. 2. Housing affordability crisis. For years, housing affordability has been a developing concern, and it continues to be a critical issue as we transition into 2024. Home prices in numerous U.S. cities have risen to a point that is becoming increasingly unattainable for the average consumer. The disparity between incomes and home prices has increased, thereby presenting a substantial obstacle to homeownership for numerous families and individuals. This issue is further exacerbated by the increasing cost of mortgages, which further strains household budgets. Consequently, the number of individuals who can afford to own a home decreases, resulting in a rise in the demand for rental properties and a decrease in homeownership rates. This dynamic has the potential to result in increased competition in rental markets and rising rents, in addition to its impact on individuals and the broad housing market. 3. Inventory depletion. For several years, the U.S. housing market has been plagued by inventory shortages, which have resulted in increased competition among purchasers and an increase in home prices. Several factors, such as supply chain disruptions, increased construction costs, and reluctance among existing landowners to sell their properties, have contributed to the scarcity of available homes for sale. Many householders are hesitant to list their properties due to the low mortgage rates they secured in previous years, and builders have struggled to keep up with demand. This persistent inventory scarcity has the potential to exacerbate affordability concerns and restrict the market's capacity to adapt to economic fluctuations. The market may experience instability and price volatility if inventory levels remain low, as it may be unable to adapt to changing demand. 4. Job losses and economic uncertainty. In 2024, the housing market is at risk due to economic uncertainty and prospective job losses. Inflationary pressures and geopolitical uncertainties are among the numerous obstacles that the United States economy is currently encountering. These factors have the potential to result in increased unemployment rates and decreased economic growth. A direct effect of job losses on the housing market is the reduction of individuals' capacity to make mortgage payments, which can result in an increase in residential foreclosures. Furthermore, consumer confidence may be diminished as a result of economic uncertainty, which can result in a decrease in homebuyer activity and a decline in the housing market. Areas that are significantly dependent on specific industries or employers may be particularly susceptible to economic downturns, as they may experience more significant declines in home values and increased financial strain. 5. Housing markets with excessive values. Several housing markets in the United States are presently regarded as overvalued in comparison to historical norms. The rapid rise in prices in specific regions has prompted apprehensions regarding the potential for housing crisis. In certain markets, the price of homes has increased beyond the sustainable level, as determined by the local economic conditions and income levels. In the event of an abrupt decrease in demand or a change in economic conditions, overvalued markets are particularly susceptible to sharp declines. If home values decline, homebuyers who purchased at apex prices may experience negative equity situations, which could result in financial strain and the possibility of foreclosure. Furthermore, a correction in overvalued markets could have broader implications for the housing market, potentially affecting investor confidence and overall stability. 6. Modifications to mortgage regulations. The viability of the housing market can also be impacted by changes in mortgage regulations. Borrowers' capacity to obtain home financing may be affected by regulatory measures, including elevated credit score thresholds or increased down payment requirements. Decrease in demand and the potential for price adjustments can result from stricter regulations, which can reduce the pool of eligible purchasers. In contrast, the reduction of regulations may momentarily increase market activity by facilitating the acquisition of mortgages by a greater number of individuals. Nevertheless, this could also elevate the risk if debtors incur more debt than they are capable of managing. Regulatory changes can have a multifaceted impact on the housing market, potentially contributing to market instability and influencing both supply and demand dynamics. 7. Demographic changes and changing preferences. The U.S. housing market is being transformed by demographic shifts and evolving preferences. The demand for housing is being influenced by the aging population and the changing preferences of newer generations. For instance, millennials and Gen Z are increasingly prioritizing affordability and flexibility, frequently choosing rental properties or smaller homes over traditional single-family homes. Furthermore, the demand for housing in a variety of sectors has been influenced by the shift in the location of residences due to the prevalence of remote work. Some regions may experience a decrease in demand as individuals relocate from urban centers to more desirable or affordable locations. These demographic and preference changes have the potential to generate imbalances in the supply and demand of housing, which can exacerbate market instability and volatility. In conclusion, the U.S. housing market is at a juncture as we advance into 2024, influenced by a multitude of factors that could result in substantial disruption. Rising interest rates are increasing the cost of mortgages, which may reduce demand and impact the affordability of homes. These dynamics, in conjunction with a persistent affordability crisis and inventory shortages, establish a precarious environment for both buyers and vendors. Let us know in the comments what you think about why the U.S. housing market might face another crisis in 2024, and don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.